Hello guys, good morning. We start in about a minute. Get ready, get your coffee. It's almost on. So guys, hello, good morning. Welcome back. Thanks for joining me at this ungodly hour. Brief question first, can you see me alright? And can you hear me okay? Nice. Super guys, let's hop in. I have on the agenda brief housekeeping, just a couple of organizational things, and essentially three topics. I want to talk about net present value analysis. I want to talk connected to this about WACC, the weighted average cost of capital. And last but not least, also connected to this, I want to talk about the CAPM, so the capital asset pricing model. What is very important to me, this is all stuff that you have discussed in year one. Well, some of you are pre-master students that probably have not heard this before or not to that extent. Some of you are exchange students, so this might also be new. The idea is to really have a brief recap of those aspects that are relevant for our corporate finance course now. What is super relevant to me is please be as honest as you can. There's no need to be embarrassed, there's no need to be ashamed. If you have a question about anything, of course, interrupt, ask your question, and I will do my best to sort it out. Housekeeping first. What's relevant? Yes, I wanted to briefly address the discussion you guys had in the Telegram group about language. So officially, a WhatsApp group, a Telegram group is of course not part of any course design officially. There are official channels. I have an official RSM email address, and you can contact me in English or Dutch or German, which is my mother tongue. That is all fine. The main idea why I wanted the group was I don't want that you get the feeling, because it's a... I'm sorry, our cat is going crazy. Jamesy, can you knock it off, please? Oh, sorry, guys. I don't want that you get the feeling, because it's an online course, that the teacher who is teaching you, me or Celine, don't want anything to do with you and are only willing to communicate via super official channels. So the main idea of this group is that you have a contact to me and to Celine, and we both speak Dutch English, so that is both fine. Of course, I have to admit I was hoping that that you also communicate amongst each other, because like a student also pointed out in the group, in year 3 you will be mixed up anyway, depending on which track you pick, and afterwards, should you do a master, even more so. So my understanding, I don't think of you as, oh well, that's an IBA student I'm talking to, that's a BA student, that does not really matter to me, you're all my students, and that is that, okay? So I'm not gonna interfere in any language conversations, I'm fine with any language, that is that. Let's hop in, guys. I have, as I said, I have 3 topics on the agenda. I want to start with number 1, net present value. I want to then hop into WACC, and last but not least, I want to look at the capital asset pricing model. All of these are, of course, mathematical concepts expressed in some sort of mathematic formula. I know from the past a lot of students, the moment they see a formula, they think, well, I'm not a number person, so I cannot do this, I'm already scared. I really want to stress that all of this makes perfect logical sense, and it, I think, can be explained in a very clear way. And should you get the sense it is not clear to you, then really it's your job to basically speak up, interrupt me, and I will do my best to explain it in a slightly different way until we're all on the same page. Let's start with net present value first. I will start really literally from 0, no worries, it's not going to be very long-winded. I just want to start at 0 and we build up very quickly to the net present value. I want to start with a very quick thought experiment as follows. Let me write down, I explain in a second what I'm doing. I'm offering you a choice. I'm offering you either option A or option B. I'm not talking now about financial options, it's not the time yet. There are just options for you to pick from. Option 1. Have a look at this. So how you have to read this is, if you pick option 1, what will happen? At t0 is a point in time, it's right now. It's happening right now. At t0, I will give you 100 euro. It's a thought experiment you cannot correct later on. Or option B, at t1, so that's in exactly 1 year from now, I'm willing to give you 105 euro. You can pick freely. Which option would you pick? Shoot it in the chat. Let me hop to the chat that I can see. Zoom chat, YouTube chat, both is fine. What would you rather do? Let me go to the chat quickly. Option A, option A, option A. I see a little bit of B. Most of you want option A. Okay, super cool. Okay, I have to, of course, then follow up on a question, sorry. Why option A? I think, and feel free to correct me, of course, in the chat, I get the sense that a lot of you want to pick option A because the logic would hold, well, it's better to get the money now because then I can do something with it right away. If that's what your underlying logic is, you're absolutely right. The same amount of money has a higher value right now than it has at some point in the future. And there is a very, I think, logical reason, a very intuitive reason for that. If I were to give you, forget about option B for now, I just slightly rephrase option B. If I had, instead of this here, had offered you T1 plus 100 euro, then your logic would be absolutely safe and sound. You would then simply have said, okay, if he gives me, if you pick option A, I will give you 100 now, as opposed to option B where you get 100 in a year. If you then pick option A, you get 100 from me right away and you can do something with it. The simplest investment that we use almost as a benchmark in finance is investing in a riskless asset, in an asset where you're not exposed to any kind of risk. So the interest rate that you would earn on such an investment, on a risk-free investment, would of course be the risk-free interest rate. So assuming that the risk-free interest rate is positive, then your decision would have been sound, because if the interest rate is positive, even if it's only, let's say, 1%, I give you 100 now, and 1 year later, so at T1, option A would have become plus 101 euro. The one euro in the end is, of course, the 1 euro from the risk-free interest rate of 1% in my example. However, that is not what we had. Our starting position was not that I offered you the same amount of money, 100 now or 100 euro in a year. That were slightly different amounts. So how to deal with this? How to deal with this is, you cannot really answer my question. If you're a rational benefit optimizing individual, like a textbook would say, then the correct answer to my question, which option would you prefer, should have been, I cannot answer your question until you tell me the applicable interest rate. So let's say the interest rate really were, just write it down, interest rate for 1 year, let's say it would have been 1% indeed. Which option, sorry, the chair's in the way. Which option would you pick then? Let's just play it out. Let's say you pick option A. I give you 100 euro now, and you choose to invest it in the simplest investment that we know in the world of finance, which is investing in an asset that carries no risk whatsoever. What do you earn on this investment? The interest rate. I should be a bit more accurate here. We all should be more accurate here. This is not just any interest rate, this is RF. RF is simply the interest rate you earn on a risk-free asset, the risk-free interest rate. So if you pick option A, 1 year later at T1, you will have then plus 101 euro. That is the cash flow that you would get 1 year later. Had you picked option B, what would you then end up with 1 year later? You would end up with, well, exactly this, 105. also at T1. Assuming you're a rational, benefit optimizing individual, which option would you pick? You would pick the option with a higher, of course, cash flow. You would then actually prefer option B. So far, so clear? Does it make sense? Nice. So let's change it very quickly. Let's say the risk-free interest rate, let me pick a different color. Let's say the risk-free interest rate, RF, were 5%. How would that influence your decision making? Well, option A then would become at T1, the 100 that I give you right away. You invested at the risk-free interest rate, 5%. 1 year later, you would have then also in option A, 100 plus 105 euro. That's exactly the same amount as option B. Then the correct answer, which option do you prefer, would be I am indifferent. Indifferent is just complicated blah blah language for I don't care, or I will decide with a coin toss. It doesn't matter, it's the same amount of money. And last example here, assuming the interest rate, the risk-free interest rate, were, let's say, 7%, what then? Then option A would become, 1 year later, T1, you would then have the 100 I give you right away, that you invest in a risk-free asset. How much do you earn on this? Well, the risk-free interest rate. If the risk-free interest rate were 7%, 1 year later, the 100 euro would have become 107 euro. What does this mean for your decision making? If you're a rational, benefit optimizing individual, you would prefer the higher cash flow. 107 is more than 105, so you would actually have preferred option A then. So what is the point I'm trying to make here? The point I'm trying to make is that interest rates matter, and secondly, money right now has a higher value than the same amount of money in the future. Why? Because interest rates matter. Because as time progresses, your investment will earn some interest income. So let's make this example a little bit more complex. Don't worry, it's not going to be super complex. Have a look at this. Let's say you are a company and you are offered a certain project. You're thinking of a certain project. I just very quickly define the project parameters so we can speak about it briefly. So let's say you're a supermarket, something like Albert Heijn, and you know you could open a new supermarket shop. Building this new supermarket shop, you know, the building, the shelves, the whole interior right now would cost minus 100. It would cost 100, so the cash flow would be minus 100. So what am I saying here? If you want to engage in this project, opening the new supermarket store, you have to pay 100 right now, some sort of startup costs. Sometimes it's also referred to as initial cash outlay. That's simply the purchase price of, well, all the stuff that makes the new store. And should you then, well, be willing to engage in this project, this is what you pay. And then you expect, let's say next year, to be able to have your supermarket up and running. When it is up and running next year, you expect to earn revenue. Let's say you expect to earn next year revenue of 105 euro. Should you do this project, yes or no? This is not such an easy decision anymore. I want to point out what simple logic indicates. This is absolutely wrong, and I don't want you to basically do this or even remember it. Some people look at it like this and say, naja, it's a kindergarten calculation. I have to pay 100 now, so minus 100. Next year I will earn 105. What's in it for me? Well, the difference here. So they say I will make some sort of profit of minus 100 plus 105 is plus 5. So yes, I should do the project. It's already bothering me just writing it down. It's of course, this is really grossly wrong, because by doing this, we would neglect the time value of money. We would neglect that this here is a present value. It's a cash flow that occurs right now in time. At this point in time, it's a present value. Whereas this here, the 105, is a future value in 1 year. So we cannot simply add or subtract them. They are almost in different units. They happen at very different points on the timeline. So in order to manipulate these numbers, in order to make sense of them, I need to basically convert them to the same unit. It's not really the same unit. It's of course all currency units. It's all euro, dollar, something like that. But I need to make sure that they basically are represented as the same kind of, cash flow on the timeline. So how would I do this? The most logical approach would be to convert the future value back into a present value. It is also completely correct mathematically and intellectually to convert the present value into a future value. It's just, I've never seen it in the real world. And the reason for that is simple. If you were to convert the present value into a future value as well, so let's say, just to show you what I mean, let's say the interest rate here were, 1%. You could then say, fine, I convert the present value here into a future value as well. So the minus 100 in 1 year will have become minus 101. This here is already a future value in 1 year. So now I'm allowed to, add and subtract them. So this here would be then another cash flow in the future at T1 plus 105. That would give me roughly a profit of €4. And it would be fine. I would say, yes, it seems to add value. How much value? Well, €4. I would do it. But you would not calculate like this in the real world for the simple reason that it's very unintuitive to talk about future values. If you were, let's say I'm your boss, and I say, hey, I want that you figure out for us, supermarket chain, should we do this project, yes or no? You go through this calculation, and then you come to my office and say, hey Flo, I have an update on the project question that you asked, and I'm all ears. Please tell me, should we do it, yes or no? And you would say, yeah, we should do it. I immediately follow up. Why? Will it add value? And you would say, yeah, it will add value. I of course say, how much? And you would say, well, the future value of the value added, the future value in 1 year added is €4. That's kind of weird to talk about it because neither you nor me are time travelers. So we would not pick a reference point in the future. So again, this is not wrong. It certainly checks out and it will certainly allow you to make the correct decision. I just find it very unintuitive. In the real world, you would not convert everything into a future value, in my example, into a future value 1 year. Rather, you would take the future value in 1 year and convert it back into a present value. All right? So just to fill in terminology that we're all on the same page, when you take a present value and you convert it into a future value, this is called compounding. So what compounding means is you basically add the interest component. When you take a future value, here a future value in 1 year, and you convert it back into a present value, this mathematical operation is called discounting. And what it basically mathematically achieves, it basically takes out the interest component. Let me fill in the actual formulas. Well, I can actually do this here. So what did we really do here in the first line to convert the present value into a future value? Like I said, the calculation is called compounding. Let me write it down briefly. Compounding. That means you know a present value and you calculate the future value. So the question that you're asking is, what's the future value of this present value gonna be? So future value in 1 year equals, let me write it down, I explain in a second. Present value multiplied with 1 plus interest rate to the power of time. Let me explain very briefly. So if you have a present value, how do you convert it into a future value in 1 year? Well, this here is the present value and you multiply it with 1 plus the appropriate interest rate. In my example here, the appropriate interest rate was 1% to the power of time. So that here would simply, the t would simply be replaced by the number of years. In my example here, the calculation that we did in our heads was 100, the present value, or to be more specific, minus 100, multiplied with 1 plus 1% to the power of 1 year. And that is so simple, that's why I picked the numbers, that even I can do it in my head. So that's how I figured out the minus 101. Sorry, still early for me. That is still early for me. 100 plus, yeah. Let me show you how to calculate the opposite, which I find much more important. This is something you will not see a lot in our corporate finance course for the reason I pointed out before. We do not convert typically present values into future values. We do the opposite. We take future values and convert them back into present values. So this would be called discounting, and this is where I need you to be relatively secure with. Discounting is the opposite. It means you know a future value. This is a future value in 1 year, and you want to figure out the corresponding present value. I need a bit more space. The formula would be like this: present value equals future value. In my example, it was a future value in 1 year divided by 1 plus the appropriate discount rate to the power of time. So in our calculation, that would be, yeah, sure.
So isn't there like also a difference between the compounding and discounting from the value? Because if you discount, if you do the net present value calculation, you get a result of 3.96, and if you compound, you get like exactly minus 101. So there's like a small difference in the numbers, right?
Yeah, it depends a little bit what kind of formula you apply. If you calculate simple interests or compounded interests. So simple interest means simply you earn interests on the amount that you have invested, but you don't earn, let's say in year 2, interests on the interests you have already earned. This is not done. Simple interest calculations are not done in the real world. It would always be compounded, and compounded simply means once you have interest income in the next period, in the next year, you will also earn interest on the interests that you have already earned. Okay?
Okay, yes.
So if we engage in this calculation with this specific example, we are trying to figure out what's the present value. So what is the value that a cash flow in 1 year has right now? A cash flow in 1 year of 105 euro. So the calculation would be 105 divided by 1 plus 1% to the power of, well, I'm discounting by 1 year from T0 back to T1, 1 year, so to the power of 1. I don't know, I cannot do this in my head anymore. As you can see, I hope you can see this, have a look. So compounding uses this mathematic approach. Discounting uses this mathematic approach. They are conceptually literally opposites of each other. Compounding is the opposite of discounting. Conceptually, compounding means converting a present value into a future value. Discounting is literally the opposite, converting a future value into a present value. So conceptually, they are opposites. And I don't know if you find it beautiful, I kind of like it. Also mathematically it shows. That's literally the opposite calculation. Present value multiplied with 1 plus interest rate to the power of time. What is discounting? Future value divided by 1 plus interest rate to the power of time. And I think I can add a little bit of value here for students that struggle with this complicated terminology that we use. I know, like I said before, in finance, a lot of the confusion is really homemade by us, the finance people, by just inventing so many terms for the same thing. So I care a lot that you basically understand the terminology and can use the terminology correctly. Have a look at this. Many of you will know this, that's of course super good. I just want to show you, if you're confused with finance, it's very likely not you. It's very likely the fault of finance. So I said here future value equals present value multiplied with 1 plus interest rate to the power of time. Present value is future value divided by 1 plus interest rate to the power of time. Okay, so far so clear. You see the variable I'm using, R, just represents some interest rate. So far so clear. But nobody in finance would call this an interest rate here. This here, everybody would call an interest rate. This here, not. Even though it's exactly the same metric, how would we call this? Does anybody know? Tell me. Excellent, guys. Yes, I heard it from quite a few of you. You're absolutely correct. When we are using an interest rate for discounting, we basically stop calling it an interest rate and start calling it a discount rate. That is not a reason to be confused. It simply indicates that we use an interest rate in a different context. So when you hear the term discount rate, don't freak out, don't get confused. It simply means, oh yeah, somebody is discounting, converting a future value into a present value. Obviously they are using some sort of interest for that, and then they refer to it as discount rate. I give you a non-finance example just to drive home the point, even though I get the sense it's clear. Let's say you read in the newspaper somebody was stabbed to death with a knife. Yeah, you can refer to the knife as a knife. But when a knife is used to stab somebody to death, very likely the police will stop calling it the knife and will start referring to it as the murder weapon. Still, they're talking about the same kind of knife. Okay? So how you use something has sometimes an implication on how we refer to it. That's all there is. Okay? An interest rate that you use for discounting is simply referred to as discount rate. Boom, the end. Those two steps are clear. Compounding relatively clear and especially discounting relatively clear. Question mark. Is it clear, guys? Yeah? Let me look in the YouTube chat quickly.
Question.
Shoot.
For the compounding, we call interest rate, yeah?
For compounding, we would refer to it as interest rate, yes? Yeah. Okay, let me just quickly look in the YouTube chat. Is annuity relevant today? Can we repeat it as well? Formula sheet for corporate finance. Okay. So I don't want to do a full recap of basically 7 weeks first year finance, but since I saw in the YouTube chat the term annuity pop up, it's only a matter of time till also the word perpetuity pops up. And we can quickly address this. The reason why we can address it is on the agenda is net present value, and this is just foreplay for the net present value. So yes, we can quickly address what an annuity is and what a perpetuity is. No problem. Give me 2 minutes. So when we know these tools, especially, like I said, discounting, we can really now hop into our official first topic, reviewing net present value calculations. Let's just do this. The example I will use is still the same as before. You are working for me. I'm the manager of a large supermarket chain, and you work for me. You're my first lieutenant, my right hand in the finance department. And of course, we're constantly thinking about new projects. So we are considering opening a new supermarket. My previous example was not very good because I said, yeah, let's pay 100 euro, open up a new shop, and then next year we will earn revenue. But that's not how it would be in the real world. Once we have opened the supermarket, we are not going to operate it only for 1 year. The supermarket will keep operating, of course. So let's make it a little bit more realistic. So our project really looks like this. Project. I make it now a little bit more complex, just so we can apply net present value. Whenever you, in the real world, whenever you make these decisions, start with a timeline. On an exam in finance, start with a timeline. And in order to just think about this, also now in class with me, start with a timeline. So the timeline looks like this. This is the timeline. This here is T0. T0 in finance as well as in physics is always the point in time right now. This here is the timeline, so T plus. What that means is, the more in this direction you go, the more into the future you look. And we have here, that is T1, 1 year later, T2, 2 years later, T3, 3 years later, ... Tn. That's n years later. How would our supermarket project really look like? Well, we have to open a supermarket right now, which will cost money. So there will be at T0 an initial cash outflow because we have to pay something. So let's say this would be minus 100. That is the cost of opening the new supermarket. And then we start operating it. I'm simplifying just so I can also explain annuity well. Let's say our supermarket has a reputation for being extremely predictable, dependable, so we have basically perfect planning accuracy. So let's assume, based on our marketing, based on our customers, every year after this, our supermarket would earn the same cash flow. Every year after this, we will earn, I don't know, I'm just making stuff up, 20 euro, plus 20 euro, plus 20 euro, and so on. And let's furthermore pretend that in year whatever, in year 5, for some reason, we will shut down our supermarket. So our last cash inflow will be in year 5, and then our whole investment, the whole shop, is so used up that we cannot sell it anymore. Should we do this project, yes or no? Let's maybe make it T6, that it's a little bit less obvious. How should I figure this out now? Again, what is incorrect would be this, to say minus 100 plus 20 plus 20 plus 20 plus 20 plus 20 is in total plus 20. So that's positive, yes, let's do it. Why would that be wrong? This here is a present value. This here is a future value in 1 year, a future value in 2 years, a future value in 3 years, a future value in 6 years. So I cannot sum up any of them. I'm not allowed to sum up a present value and a future value 1 year. I'm not allowed to sum up a future value 2 years with a future value 6 years. For all intents and purposes, that's like adding up kilogram, centimeters and Newton meter per second. That's just grossly wrong. Why? Because we are neglecting the time value of money. We are neglecting that money right now, or closer to right now, has a higher value than the same amount of money further into the future. So the way to deal with this would be to make all these cash flows basically the same kind of values. It would be totally bizarre, please don't do it, only for practicing purposes. It would mathematically and conceptually be correct to say, fuck it, let's just convert everything into a future value year 3. So then I would take the present value and compound it for 3 years, the future value 1 year and compound it for 2, the future value 2 years compounded for 1, the future value year 3 is already a future value year 3, so I would not have to do anything, and all the cash flows afterwards I need to discount. I could do this, then I would end up with a net present value that is phrased as a future value year 3. Mathematically, that's super accurate, no problem there, but imagine the communication about this. So that would be really bizarre. So that's not what we would do. What we would do is we are creatures of the present time. We are living at T0 always, unless we become time travelers, hopefully at some point. So it's more natural to express monetary values as present values. So what I would do is I want to calculate a present value, a very big one. I want to basically convert all of these into present values so I can sum them up. And if the result is then positive, it means engaging in this project will add value to our firm. If the total present value of all these cash flows is negative, it means engaging in this project will be value destroying. And, almost done, the first cash flow, as you see, is an outflow, it's a minus. Money leaves my pocket. All other cash flows are cash inflows. So some of the numbers I add up here have a minus, others have a plus. Whenever we do calculations like this, mixing pluses and minuses, the result is a net position. Think about salary. You work for me, I pay you a gross salary of 1,000, but that's not the money you get on your bank account, because the Ministry of Finance will say, how about some income tax, please? So you pay 300 euro income tax. What arrives on your bank account is then only 700 euro. I pay you a gross salary of 1,000. The moment we deduct the taxes, in my example 300, what is left, your salary of 700, that really arrives on your bank account, would be referred to as a net salary. Why? Because the cash inflow, your salary is plus, and the tax payment is a minus. So whenever we mix this, we call the position net. So we are not simply calculating here a big present value. Just the fact that the first cash flow is negative and all the others are positive means we are calculating a net present value. So I'm calculating now the net present value of the whole project. This here, the initial cash outlay is already a present value. I don't need to do any mathematic acrobatics. That already works. Minus 100. Students make fun of me. I think there's even a meme. Because here I always say do not drop the initial minus. And the reason why I say this is it's very common to forget about this. And of course then the whole calculation will become crap and completely wrong. Don't drop the initial minus. That's also very lifelike because most investments start by you having to pay something. Okay? Don't drop the initial minus. Plus. Let's deal with this future value in 1 year. It's a future value 1 year. I need to discount it by 1 period, by 1 year. So I need to discount only by 1 year using the formula from before. So plus 20 divided by 1 plus interest rate to the power of time. So that's 1 year to the power of 1 plus the second cash flow. That's a future value 2 years plus 20 divided by 1 plus interest rate to the power of 2. Again, this is the power of time. We are in year 2, so to the power of 2. Plus 20 divided by 1 plus r to the power of 3. And so on. Until our last cash flow in year 6 plus 20 divided by 1 plus r to the power of 6. What does this achieve? What it achieves is this. This term here achieves that I'm converting a future value in 1 year back into a present value. This here is a cash flow that will occur in year 2. So this operation achieves that I'm discounting it back by 2 periods, again to convert it into a present value. And so on. The last thing I want to point out here, I'm engaged here in a big discounting operation. So very likely when we speak about it in my office, I will not say 20 divided by 1 plus interest rate, but as I've said before, very likely I would refer to this interest rate here as a discount rate. Again, simply because I use it for discounting. So we would fill in the numbers, press the buttons, boom, done. If the net present value is positive, net present value larger than 0, we would do the project. If the net present value were negative, so smaller than 0, we would not do it. Don't. Okay? There's one thing missing, of course. No, sorry, brief sidebar. Is everybody still on board? Does this make sense? Do you, first of all, understand it? Do you maybe recall this conversation from year 1? Does it make sense? Everybody on board? Let me check the YouTube chat. Super. Okay, seems all to check out. Very nice. Very nice. Any questions about this? You understand the mathematic operation I'm using? I'm discounting here. Another question, you understand why I'm not discounting the minus 100, right? This is a present value already. It will occur right now. No mathematic operation necessary. So eventually I end up with a stream of cash flows that are all expressed as present values, and I'm free to do mathematic operations with them as I see fit. Let me check the time. 39. Okay. There is one thing, and that's, I think, a very cool, basically logical breakpoint for us to have a break. There's one thing here, or a couple of things I want to point out. So it's totally common in the real world to set up these net present value calculations, of course, in Excel. You would do this. There are a couple of important things that I want to point out. It's almost like a warning. When you work with Excel, it's very easy to succumb to a false sense of accuracy. So what I mean with this is, Excel will calculate a net present value to 50 digits after the decimal point if you want that. And then you look at your result and it says something like net present value equals 1327.5378 whatever. And you get the sense, holy shit, I'm doing something super accurate. Nice, let's do it. I want to just circle now in my calculation all input parameters that are tainted with uncertainty, okay? So what I mean with this is I want to circle all parameters I'm using here that we actually are not sure about. Let me show you. Let me point this out. So the minus 100, is this a number that I can rely on? Yes, this is a number I know with absolute certainty. Because if I want to open a new supermarket, I simply create some sort of checklist. What is all the stuff I need to open a supermarket? I need a building, I need the fridges, I need a cash register, I need whatever lamps and stuff like this. Then I go to bol.com and I look up the price of all the things that I want and make a huge wish list. And I see the grand total. That's what I have to pay right now to make my supermarket dream become a reality. No problem. Let's talk about the cash flow that I expect to be earning in 1 year. Is that something I know for sure? No, of course not. Of course not. That is an estimation. What about the revenue that I expect to be earning in 2 years? That's even more in the future and therefore even more uncertain. I do not know this with certainty. What about the cash flow in year 3? Even more uncertain. The cash flow in year 6, even more uncertain. The more we go into the future, the more uncertain events become, of course. What about the interest rate I use for discounting? So what about the discount rate? Do I know the discount rate I should be using with certainty? Well, it's the last thing I'm going to say before the break. The discount rate that you use, so the interest rate you use for discounting, should reflect the riskiness of the future cash flow. So if this is a very risky cash flow, the discount rate should be very, very high. If this is a cash flow that is guaranteed, maybe we have an exclusive contract with the Dutch government and the Dutch government says we have a legal contract, we only will buy our groceries from you guys. So you know for a fact that every year you will make a revenue of 20 from your business with the Dutch government. If it's guaranteed, then the discount rate would not just be low, then you would say I use the risk-free interest rate as a discount rate. So the discount rate should reflect the riskiness of the cash flows. Do I know the riskiness of the cash flows very accurately? Not really. So that means also the discount rate is some sort of estimate. So if we are looking now at this really honestly and without, without any illusions of omnipotence, we have to acknowledge what we do know for certain are actually very, very few things. What we do know for certain is our initial cash outflow, and we know the power of time. Everything else are approximations. So the point I want to drive home is when you work with Excel and you set up a beautiful Excel sheet, it's very easy to get sucked into sort of the logic of Excel and succumb to this false sense of accuracy, because every result in Excel will look super mathematical and super accurate. I want that you really, also for not only for exam, for real world calculations, that you know, 90% of the parameters we're using in our calculation are estimates or even guesstimates at best, and whatever result we get will be very, very inaccurate. Okay, so don't succumb to this false sense of accuracy. But this is how a net present value calculation plays out. Guys, before we hop into our break, are there any questions about this? Anything that I can help clarifying, explaining again? Anything at all? If yes, please unmute yourself or shoot it into the chat. Let me see if there's something I need to... Yeah?
Regarding Excel, I know this problem and I do agree that it is a problem because you just see numbers and not the graphics anymore. But a way I overcame this last year is by by actually like writing out the time period. So you have like time period number 1, 2, 3, 4, 5, and so on. And you can also write out like the discount rate, so R, as a single input. So you kind of see like the different time periods and the discount rate. And you can see like the parameters or the variables which influence your calculation.
I think it's a great approach. That's exactly how I would do it as well. In my own calculations, I would not write it out like this. Well, I would write it out like this, but I would not type it into my sheet or into my calculator in one go, where I only get then one number as a result. I would break it apart because I don't trust myself. I constantly lose my concentration and make typos and all of this. So I would actually really calculate every term individually. I would separately type in this term, calculated, this term, calculated, so that I really have a neat, sort of almost like a table, future value year 1, future value year 2. Let me show you. So the table would look something like this. And in Excel, it's super easy to set up. So I would have a table. I would have here the present value, of course, it's year 1, obviously. Future value, year 1, future value, year 2, future value, year 3, and so on. I would then have here a column that is only called present value. So this here is already a present value, and for each term I would write my result down separately. If the cash flow is every year exactly the same, I would see any mistake I make in my table very quickly because the values here have to decrease. Each future value has to be less than the future value before. So that's just my approach. The main message I want to send is don't make the mistake of thinking because this looks very mathematical, we're engaged in an exercise in accuracy. Most of our input parameters are estimates and the results are therefore notoriously unreliable, inaccurate, and tainted with uncertainty. Okay? Guys, shall we have our coffee break? Shall we have a 10-minute coffee break? Here it's 47. Shall we reconvene here at 57 in exactly 10 minutes? Perfect, guys. I see you in a bit then. Guys, we continue in about two minutes, maybe 3.
It's possible.
Guys, come back. Come back to me. Join me again. So guys, I just saw in the YouTube chat a question that is something I screwed up. The question was, the question was, why am I deducting here the last term? That's just my handwriting. I didn't deduct, that's really ... to indicate that I'm skipping a couple of terms in between. That is not a minus, okay? I promised to also quickly address the question from the chat, what's an annuity? And I cannot talk about an annuity without then immediately saying what is a perpetuity. So let's quickly map this out. That's just terminology. There's nothing complicated about it. Have a look at this. Let's say you're looking at a timeline that looks something like this, t plus, and for whatever reason you're engaged in some project that looks like this. So this is t0, this is t1, this is t2, t3 and t4. Whatever happens at t0, irrelevant for us. Let's say your investment will give you a cash inflow of 100 in 1 year, of 100 in 2 years, of 100 in 3 years, and of 100 in 4 years. And then your investment ends. So what you're looking at here is a timeline where in every year you get, or theoretically it's also true if you were to pay every year the same amount of money. But only for a specific amount of time, like in my example, 4 years. So something like this is what we call an annuity. Annuity. That simply means, the word, whenever you hear the term annuity, it means that you either will receive or you will have to pay the same amount of money for a specific number of years in the future. And what I mean with specific number of years, I mean there is an end to it. It will not continue infinitely. That's an annuity. Same amount of money every year, and at some point it stops. Annuity. What is a perpetuity? Well, a perpetuity is the same thing, only it describes a cash flow that you either earn or that you have to pay forever. So it would continue plus 100 forever. That is what we would call then a perpetuity. Both terms are derived from Latin. The word annum in Latin means year, and the word perpetuus in Latin means forever. So an annuity is the same amount of cash every year for a fixed number of years. An annuity is the same thing, a cash inflow or outflow, always the same amount of money, 100, 100, 100, but it has no stopping point, it will continue forever. That's what that is, all right? Annuity and perpetuity. Let's talk about the second topic on our agenda, which is WACC. So the WACC, let me go to the net present value calculation maybe first. The WACC, the weighted average cost of capital, is extremely important for us for a very simple reason. I pointed out in the context of our net present value calculation that we have engaged in from the firm perspective, because we wanted to know, should we do the project or not? So we have estimated as best as we can our cash flows, and then we said, fine, let's just discount. Yeah, but it is not so easy, because when you do exercises from the book or on Connect, then every exercise will say the appropriate discount rate is 3%. Boom, you know what to do. Fill in 3% here. In the real world, nobody will tell you that. So the question actually is, how can we do a net present value calculation when we don't know what we are supposed to use as a discount rate? So what you are supposed to use as a discount rate in the real world is the weighted average cost of capital. Let me explain this very, very briefly. It should not be the first time that you hear this, but I want to emphasize what the WACC really is. So think about a firm in terms of a balance sheet: assets, liabilities, and owner's equity. We have our assets here, we have some amount of debt, and we have some amount of equity. This is debt, and this is equity. So we want to figure out how much are we actually paying for obtaining this finance, this sort of financing that we use to pay for all our assets. And it's not really rocket science. So how do I know how much I pay for the debt that we have? Well, debt is, the simplest form of debt would be a bank loan. So let's say, just to have a couple of easy numbers to process, let's say we have 100 euro debt and 300 euro equity, okay? We want to figure out how much do we pay for our debt. Super easy, barely an inconvenience. What would we do? We simply look at the loan contract. We have a loan from ABN or Rabobank or ING, whatever, and it says, yes, we give you a loan and it costs 3%. Fine. I just successfully figured out the cost of debt. How about the cost of equity? Well, that's something that we still have to determine then. That's a question mark. For the time being, I want to just make an assumption here. I will explain in a second how I actually get this. For the time being, I'm just simplifying a little bit and I say 7%. Let's say the cost of equity is 7%. What is then the total cost of our capital? Again, this is wrong, don't do it. I write it down and I immediately will delete it. You could actually look at it something like this. Well, for debt we pay 3%. For equity we pay 7%. So 3 plus 7 is 10%. Divided by the two sources of capital we have, 1, 2. So 10% divided by 2 is 5%. So the average cost of capital would be then 5%. But that is not what we can operate with. Why not? Tell me. Why would this be inaccurate? Don't be shy.
They don't have equal market value. Like debt is 100 and equity is 300.
Very nice. Absolutely correct. Wait, I got a window here popping up. Let me click this away. Yes, Dylan, you're absolutely right. We don't have the same amount of each kind of financing. We have a lot less debt than equity. So if I were to calculate a normal average, it would be wrong. So a normal average is simply not going to cut it. We have to actually calculate a weighted average cost of capital. So I need to consider how much debt do I have, how much does it cost, how much equity do I have, and how much does that cost. And that is very, very easy. In my balance sheet, you can actually see the weights at one glance. That's of course why I've picked them in this way. So you can see that we have 25% debt, and we have 75% equity. Does everyone see how I figured this out? Our total capital is 100 plus 300, so 400. And I simply ask myself, what's the percentage the debt makes up in the 400? What's the percentage equity makes up in the 400? Now that's clearly 25%, that's clearly 75%. And we're almost there. We're almost there. So what is our weighted average cost of capital? Well, we have here now the weights. This here is the weight of debt, and this here is the weight of equity. And weight simply means how much of that do we have expressed as a percentage. Very important sidebar here. This is a percentage and this is a percentage. But please don't confuse them. Think of this here as an interest rate, but this is a weight. This is not an interest rate, okay? It's easy to confuse. They are not the same thing. And then, we're almost there. I can set up my calculation. What is gonna be my weighted average cost of capital? Well, conceptually, it is this. How much debt do I have? 25%. Multiplied with however much I have to pay for it, 3%. Let me write it down. 25%, that's the debt, multiplied with 3%, plus, I move on to the equity. How much equity do we have? 75%, multiplied with the appropriate cost of equity, 7%. So this and this here are weights. Weights. So this is the weight of debt. This is the weight of equity. This here is the cost of debt. And this here is the cost of equity. Is everybody still on board, guys? Yeah? Let me check the YouTube chat. All right. That seems... Bring it, of course.
Why there is an interest rate on the equity? Because you don't have to pay, about the equity.
Excellent question, Eva. Yes, super question. Eva asks, in case you have not heard this on YouTube, why do we have an interest rate on equity? She is absolutely right in pointing out, equity is very different from debt. It's not like we borrowed equity and promised the shareholders we will pay that back at an interest rate of 7%. So Eva has a point. This is not an interest rate. It acts like an interest rate. How does that work? Brief sidebar. And as you've seen, I've just made up the 7%. Really, there is a question mark here, so I have not addressed it yet, how I get this number. But the conceptual logic I can already point out. Now, if I'm a firm, you are looking at my firm and you say, wow, this seems like a good business model, this seems like a decent manager, and you start considering becoming my shareholder, buying my shares. Obviously you want that there is something in it for you, but you're specifically not giving me a loan, you are considering becoming a shareholder. What's in it for the shareholders when they invest in a firm? Two things. Number one, a share of the future profits that the company will make, so that's called dividend. And secondly, the price of our shares, of our stocks, so the price of our traded equity might increase in the future. So that means if you buy my share now for 100 and I as the manager of the firm keep operating in a decent way, we will make profits, and more investors will want to buy our shares. So they buy, but the number of shares of my firm is constant. So that means the supply of shares is constant. The demand for my shares will go up because I'm such an awesome manager and the company is performing likely very well. So that means the price of the shares will go up. If you then sell your stock a couple of years down the road for 110, the difference between what you paid for the shares versus what you sell them for will be your profit, and that is called capital gain. So what is in it for the shareholders? When they become shareholders, they are hoping for dividends and they are hoping for a capital gain. And the shareholders make a very simple calculation, they basically engage in some sort of calculation in their head. They say, well, the firm has a certain riskiness, equity is more risky than debt, so you as a shareholder want to earn a certain return. And the dividends that you expect to earn and the capital gain that you expect to earn, I can express as a percentage, and that is what I've written down here. So it is not truly an interest rate. It is, from your perspective as a shareholder, technically a return. And you could say, what's the return on your savings account? Well, the interest rate. So that's why I use it or I may use it like an interest rate. But this metric will become clearer in a second, all right? Does it make sense, Eva?
Yes, thank you.
Super, okay. So we're almost done. So what we have done here now is we have really calculated a weighted cost of debt and added to it a weighted cost of equity. But we are not done because there is one specific thing, a peculiarity of debt. Payments on debt are tax deductible, not only for firms, also for private people. So I have a house in Rotterdam, mortgage financed. When I pay every month my mortgage, this of course interest expenses from my perspective, I'm allowed to deduct them from my taxes. So it gives me a slight tax advantage. So I need to consider that when a company pays interest rates on their outstanding debt, these payments are tax deductible and helps the company later on in their income statement end up with a lower profit before tax and therefore a lower tax payment. So that means I need to consider this. This is called tax shield. So the calculation here is actually not fully correct yet. So I will delete the equity part for a second. We need to factor in, I'll delete everything. Let me do it fresh because we are at the final part of WACC. The WACC is exactly what I have written down. Only a small part is missing. Let's start with the equity first because it's easier to process. We are weighing the cost of equity. We have agreed that we have 75% equity multiplied with the cost of equity of 7% plus our weight of debt 25% multiplied with the cost of debt, which is 3%. And because this is tax deductible, I need to consider the tax shield, so the property that helps us save taxes when we pay interest expenses. So therefore I will multiply this with a final term called 1 minus the corporate tax rate. And as you see, mathematically and also conceptually, this here is 1 unit. The weight of debt multiplied with the cost of debt multiplied with, this here is the tax shield. And that is the WACC. So what does this achieve now? It tells us the weighted average cost of capital. Why is it weighted? Because the W is here and here. Why is it a cost? Well, because we're factoring in here a cost of debt, cost of equity and a cost of debt. And why is it called cost of capital? Because debt and equity together are referred to as the capital. So that is the WACC. And I only have one more thing to fill in. I want to write down now the mathematic official formula for the WACC so that everything connects neatly. I use a new slide. How did we calculate all of this? Easy enough. I write it now down in the abstract way. The WACC is calculated as, I need to calculate, step 1, the weight of equity. How did I do this? Well, in my head, because the numbers were so easy, but what I really did is equity divided by equity plus debt multiplied with cost of equity, which is abbreviated as RE, cost of equity, plus debt divided by equity plus debt multiplied with RD, that's the cost of debt, multiplied with 1 minus the corporate tax rate, which is the tax shield. So the only thing I have done is now written down what we have elaborated on in a very intuitive way in a mathematic form. So the weights here, these are the weights. That's the weight of equity. This here is the weight of debt. Weight of debt, everything else we have discussed. Cost of equity, cost of debt, tax shield. So this calculation looks maybe a bit abstract, don't be intimidated. That's simply in our example, it was, let me write down the numbers. This term here in our example was how much equity did we have? 300 euro. and then we divided it by 300 plus 100. Simply how much equity we had in the balance sheet and how much debt we have in the balance sheet. So that is what gave me the result 75%. How did I do this with debt? Well, we had 100 debt divided by 300 plus 100. Do you recognize this formula from your first year course? Okay, does it make sense? Is everyone on board? Let me check the YouTube.
One question.
Shoot.
The 7% that you mentioned earlier, saying that that's the return that the shareholders are trying to achieve,
Yeah.
would that be also considered the market yield as in bonds?
It's not a, no, because this here is really equity and bonds are a debt instrument. That is a debt instrument. I appreciate it. Also, Eva already brought up the cost of equity and now we have it again. So your intuition is right to be drawn to this. Remember, don't lose out of sight what we're doing. We are basically going through a very, very elaborate decision-making process. Have a look. Let me point this out quickly. So step one was this. We are a company. That's our balance sheet, assets, liabilities, and owner's equity. Oopsie, owner's equity. And we are trying to figure out if we should engage in a certain project or not. A project would manifest on the left side of our balance sheet as a group of assets. If we were to open the supermarket, it would be a building, it would be office equipment, fridges, cash registers, and so on. So they would pop up here as assets. In order to determine should we do this project or not, actually we say, let's do a net present value calculation, question mark. Based on the formula I have mapped out. So we said the net present value of our project equals minus the cash flow at T0 plus the cash flow we expect to earn in 1 year, but discounted back to T0. Let me just write down a couple of terms. 1 plus R to the power of 2 plus ... plus cash flow in year n divided by 1 plus R to the power of n. So this was our starting consideration. We said, should we open the supermarket, yes or no? Opening it would mean we have to pay something now. Then we expect certain earnings in the future until year n. They are all future values, so we need to discount them back. But then we immediately ran into a problem. The problem is this. What should we use as a discount rate? And then we said, okay, well, before we can do this, we actually need to figure out the risk-appropriate discount rate. And that's what we just did. So we then said, okay, fine. The discount rate is the WACC equals equity divided by debt plus equity multiplied with RE, so the cost of equity, plus the weight of debt, debt plus equity, multiplied with the cost of debt, RD, multiplied with what we are going to save in taxes, in corporate taxes. So 1 minus TC, the corporate tax rate. And this is where you guys now hopped in, Eva as well as Maximilian, by saying, now wait a second, all of this is actually clear, but what about RE? That's something in my example I simply invented. I simply said, yeah, fine, whatever, 7%. But you're right, this is not something we can actually make proper statements about. So there is a last step that we need to actually do, or to be more specific, it's not the last step. It's really the first step, because so far I've just written down the formula, net present value. Crap, cannot do it because we have no discount rate. Then we said, okay, let's do the discount rate, which is the WACC. So fine, let's start with the WACC first then. Then I wrote down in this very important way, oh, that's the WACC. And we run into the next problem. Oh crap, we don't know RE now. How to deal with this? And this is where we need the CAPM now. So the CAPM actually tells us the cost of equity. Let me write down the formula and I will explain in a second. RF plus beta multiplied with RM minus RF. So this is the CAPM, the capital asset pricing model. Model is just complicated finance, blah, blah, for an equation. Something equals blah, 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 something else. So this is an equation, and in finance we like to make ourselves more important than we are and like to make our field look more complicated than it is. So this is what we call a model. So, sorry, I made a mistake here. I wrote CAPM equals, that's of course nonsense. The CAPM, this is the CAPM. The CAPM gives us RE, sorry, RE equals, okay? There is a lot of confusion about the CAPM, I suspect, because it's not always explained in a very down-to-earth way. So I want to briefly address what it is that we are calculating here. What we are calculating here depends on who is calculating it. I am a company. No, let's start differently. You are an investor and you look at my firm and you ask yourself, based on the riskiness of this firm, how much in return should this company offer me that I, as a potential investor, would be willing to accept the risk? So what you are doing as an investor when you use the CAPM, you would calculate here something that you yourself call, let me write it down, required return. The required return. Why required? You would say in wording, I require to earn this return based on the level of risk of this firm so that I'm willing to engage in it. That's why you require it. I, on the other hand, I'm the firm, I use the exact same formula like you, I fill in the exact same values as you, but I will not say I'm calculating a required return. What is it that I, the firm, am calculating? Please tell me. Don't be shy. What is it that
Cost of equity?
Say again?
Cost of equity?
Are you asking me or are you telling me?
I'm telling you.
Excellent. Yeah, be confident, all right? You're absolutely right. When the firm applies the CAPM, the firm is not calculating a required return. The firm is calculating a cost of equity. Cost of equity, which is of course RE. And just to drive home this point, a lot of times I see people being confused about this, but it's very intuitive. You know this from every day. Example, I am a bank, I'm ABN AMRO, and you're a student who graduates very soon from RSM, and you will take out a mortgage, you want to take out a mortgage and buy a house. So you go to your bank, which is me, and you say, okay, I need a loan at a certain interest rate, blah, blah, blah. And I give you a loan, 5%. I give you 100 at 5%. That's the interest rate. Then you would say, aha, 5%, I borrowed 100, so what is my interest expense? Well, 5% of 100. So you would say, the €5 that you've just calculated, you have just calculated your interest expense. I'm the bank, I'm ABN AMRO, I engage in the exact same calculation as you. I also end up with €5, but I will not go around saying, oh, I've just calculated an interest expense. It's your expense. From my perspective, I have calculated interest income. We are talking about the same cash flow, the €5. From your perspective, it's an interest expense because you have to pay. From my perspective as the bank, it's of course interest income because I collect. So that is not an unintuitive thing that we're talking about here. That happens all the time. So from the firm perspective, the result of the CAPM gives us indeed the cost of equity, because it is what you as a shareholder want to earn, or even more dramatic, what you are required to earn. So what you require to earn as a return, logically on my side, as the person having to pay it in some way, is of course a cost of equity. Does this distinction make sense? Does the connection make sense, guys? Yeah? I just want to have a look at YouTube, that everything is cool. Yeah, I see in the YouTube chat expected return. This is really not so trivial anymore. I don't want that you think you are calculating here an expected return purely. I would probably say this is really, strictly speaking, a required return. So it does not mean, when we casually sometimes say high risk, high return, it does not mean if an investment has a very high risk, you will earn a high return. It actually means an investment that has a high risk, you should only engage in if you can get a high return. Okay? So you would require it. It's not a given. There are plenty of very high risk investments that have very low returns. That simply means you would eliminate them, you would not do them. Okay? So let's go through the logic of the CAPM, and that is it. Let me see the time. Super. This is gonna... Is there a question?
Yeah, quick. So we're talking about discounting all the time, but is the discount rate that we are now calculating, is it the same also as the compounding, the interest rate? Is it also applicable, the WACC and the CAPM is also applicable for the compounding rate?
Yeah, I mean, it depends a little bit. It's a good question. It depends a little bit in which context you are compounding. So the WACC in a business environment is technically really used for discounting project cash flows in a net present value calculation. If you were a company that decides on a project, should we do it yes or no, you would go through exactly this step. Let's do a net present value. Oh crap, I don't know the discount rate, so let's calculate the WACC, and that's what you would use. If you're a firm that says we have actually excess cash, we have too much cash, we want to invest it in something, I'm simplifying, but let's say the bank says let's put it on a savings account, and the company then wants to figure out how much money will this investment earn in the future, they would not compound then with the WACC, they would compound then with the appropriate interest rate on that specific investment. So the interest rate that they earn based on the contract with their bank on their savings account. So the WACC is really used for discounting, it does not tell you anything about earnings in a compounding calculation. No. Does it make sense what I'm saying?
Yeah, I guess. Thanks.
Super. Okay. So the only thing I feel like I still owe you is I need to explain what actually the CAPM, what it is. Well, we discussed what it does, but what the components represent. So let's do this. Like I said before already, that is not some abstract nonsense. That really makes sense. Let me write it down and I explain in a second what everything means. So the CAPM equals RE is RF plus beta multiplied with RM minus RF. Okay, I want to talk about it now from your perspective, okay? Because that is more intuitive. You are potential investors, you are looking at my firm, and you are trying to figure out, should I invest in this firm, yes or no? Let's zoom out a little bit and talk first what an investor actually wants. So if you, as an investor, invest in anything, any kind of investment you can think of, you want to be compensated for two different things at the same time. So if I, just a simple example, I, as your finance teacher, could approach you in a break and say, hey, I'm a little bit short on cash, can you give me a loan of 100 euro? You would consider it and then you would say, okay, yes, but you want compensation. You're not happy just by giving me 100 and I pay 100 back a year later. There needs to be something in it for you. So to the very least, you want to be compensated for the time that you do not have access to the money now yourself, because the moment you give me 100 euro, the money is in my pocket and you don't have it anymore. So just for that you want to be compensated, for the time that you don't have access to it. And I think it makes intuitive sense because, let's talk about the counterfactual. If you did not give the 100 euro to me, what else would you do with it? The simplest investment in finance would be an investment at zero risk, which would earn you the risk-free interest rate. So you would say, yes, I can give you a loan of 100, but to the very least compensate me for the time that I don't have access to it, because if I didn't give you the loan, I would put it on a savings account and earn the risk-free interest rate. So number one, you want to be compensated for time. Secondly, you would say, wait a second, I mean, he looks like a neat guy and he's teaching at RSM, but what do I really know about him? He might be the least reliable person ever. Maybe he doesn't pay it back, or maybe he dies tomorrow because of the smoking habit or something like this. So you would say, just me compensating you for the time by paying you the risk-free interest rate would probably not cut it, because you would say, that guy is not a zero risk investment. So earning only the risk-free interest rate is simply not enough. You would not want only compensation for the time. You want to be compensated for the risk as well. Okay? Does this make sense? Otherwise I refuse to continue. Yes? Let me see in the YouTube chat. Okay, seems to be all right for now. You can interrupt me at any point in time. Just unmute yourself and make yourself heard. Any investor wants compensation for two things, time and risk. We are calculating here a required return. So exactly what we are talking about. What is it that the investor really wants? So if what I just told you is really true, the two aspects of compensation for time and compensation for risk must be identifiable in our beautiful formula. Otherwise it's crap. Let's look at it. I said two things. Any investor wants to earn a certain return, some sort of compensation, right? There are two components that make up the return that you want. Compensation for time, compensation for risk. I explain, of course, in a second. This here is the compensation for time, and this all here is the compensation for risk. And not just any risk, it's the compensation for firm-specific risk. So that's not just some abstract risk kind of thing in the sense like, isn't risk the same as opportunity? No, that's the specific mathematic risk of one specific firm. So I actually want to take it a bit further even. I'm not happy with how I wrote the formula down, because I make it look like that's some general thing. We are calculating the required return on a specific share or stock of a specific firm. So that would be, for example, RE of Apple or RE of Microsoft or something. And there's another firm-specific metric in there, beta. There's not one beta. Every firm has its own beta. So the beta that I use here is the beta of Apple or whatever firm I'm analyzing, okay? So the risk compensation is really firm specific, and we're almost there. Let's just look at the first part. You as a potential investor, you want to be compensated for time and risk. Let's talk about the time compensation first. This is really 100% consistent with my example now. You give me a loan and I compensate you for the time by paying you the risk-free interest rate, because that's only the compensation for time, and by definition the risk-free interest rate is what is paid for a zero risk investment. Logically it means it only compensates you for time. So this is the time compensation. Let's look at this term now. In order to understand the second term, so the risk compensation, we need to talk about beta. So I only want to zoom now into beta and explain it, and then we hop back to this, okay? What is beta? I'm quite confident that you remember from your statistics courses or research skills courses the concept of correlation. Correlation, the correlation coefficient, tells you something about the relationship between two variables. Very quickly, let's say this is not correlation, okay? This is not beta. It's basically a refresher on correlation, or the correlation coefficient, I should say. The correlation coefficient is abbreviated as the Greek letter rho. And rho can only have very specific values. It can only be between -1 and +1. It is standardized, and it tells us something about the relationship of two variables. I just show you in a very concrete example. I plot on this axis how tall people are in centimeters, and on this axis I plot how heavy or light people are in kilogram. And we could do this for our whole group of students, including myself. Each of us is a data point. So I'm, for example, on a good day, 175. This is 1 meter. This is 2 meters. So I like to think I'm 175, somewhere here, and I have close to 90 kilos, something here. So that's my data point. And I can plot this for every one of you. And what we would find is that our data points probably would form a shape something like this. And that makes sense, because typically the taller people are, the heavier they are, and vice versa. So a baby, a newborn baby that's maybe, I don't know, 40 centimeters, is typically also very light. If you think back of Lord of the Rings, the big orcs, the Uruk-hai, they're like 2.5 meters tall. They would be somewhere here. They are huge, so they are probably something like 150 kilos. And normal humans, like you and me, we would be somewhere in between. So this here is a relationship between the two variables, size in centimeters, weight in kilogram, of the form, the more. So this here would have a positive correlation coefficient, maybe something like plus 0.8. For every 1 unit more here, 0.8 units more here. That is a positive correlation. An example for a negative correlation, this I can plot here. I'd use a different color. I could plot here the money I have on my savings account, and here how much money I spend on my groceries. Logically, for every euro I spend more on groceries, I have 1 euro less on my savings account. So this is a relationship between two variables, money spent on groceries versus money I have on my account, of the form, the more, the less. So this is a negative correlation. There's a perfect negative correlation. Rho equals -1. Because for every 1 unit increase here, the other variable, money on my savings account, will go down by 1 unit. So it would look like this. And last but not least, we don't have to talk about this much, two variables can be completely uncorrelated. So that would be rho equals 0. That means they have nothing to do with each other. That looks something like this. You just get random dots everywhere. Okay? So long story short, correlation tells us something about how two variables relate to each other and move together or don't move together. That's the correlation coefficient. I want to draw your attention to this here. The correlation coefficient is standardized, meaning it can only have values between -1 and +1. In case you're wondering, wait a second, we were supposed to talk about the CAPM, specifically CAPM Beta. Why is he on this weird tangent on correlation now? I want to come back to the CAPM now, the CAPM Beta. The CAPM Beta is very similar to a correlation coefficient in the sense that it tells us something about the relationship of two different variables to each other. But it is not standardized. So beta can have any kind of value. It's not constrained to a certain range. It can be any value. Let me also draw this briefly for you. Let's talk really now about the CAPM Beta. Only this one variable now. I'm drawing here a stock chart. So this here is now a timeline, T plus. And here on this axis I plot returns. And I have to introduce now a concept. Let me go to the CAPM formula that I can show you. Observe that one of the parameters I have here is called RM. RM is the return of the market or the return of the market portfolio. What that means, it's not some abstract thing, it's a concrete thing. What the return of the market is, it's the return of a specific index. So every stock typically is part of a specific index. So for example, Apple, Google, they are part of the NASDAQ. The NASDAQ is the technology index, and an index is simply a sort of virtual basket in which we put stocks of companies that have certain things in common. So for example, the NASDAQ is a basket in which there are stocks of typically large companies that are all very technology related. And I can, of course, calculate the return of one specific stock, but I can also calculate the average return of a whole basket of stocks of the NASDAQ in my example. And because, let's say I'm looking at the stock of Apple, Apple is the individual stock I'm analyzing, but it is in the NASDAQ basket. It is traded as part of the NASDAQ index with all the other technology stocks. So the reference would be the return of the whole market portfolio. In my specific context, Apple shares that are traded as part of the NASDAQ. RM would really be the return of this specific index of the NASDAQ. Okay? Does this make sense, guys? It's simply a basket with very similar stocks. Okay, very well. Almost there, guys. The worst is absolutely behind you. So, what I'm doing now in the first step, don't forget we actually talk about Apple, one specific stock. But first I plot the movements now of the market portfolio. Since Apple is part of the NASDAQ, the market portfolio is the NASDAQ itself. And I'm plotting here now the returns of the NASDAQ. So, the NASDAQ is, let's say, moving something like this. I'm just making stuff up completely. So this here is the return of the market portfolio. In my example, it's the NASDAQ, RM. Okay? I use the notation of the CAPM. But we all know this is a specific basket with technology stocks, the NASDAQ. And now, in a similar logic as the correlation coefficient, I overlay my drawing of the movements of the whole market with the specific stock movements of the one stock I'm interested in, which is Apple. And it could be something like this. Apple might move like this. Okay, Apple. It's just an example. My question is, if you look at this, would you say Apple, in my diagram, it's really invented, would you say Apple is more risky than the market portfolio, as risky as, or less risky? Tell me. Excellent, guys. Yes, I heard it from several of you. It's more risky than the market. Why? As, let me add here a bit of a sort of helping line. As the market, the green line, goes up, let's say by 1 unit, Apple has increased. It has moved, as you see, also in the same direction. It has also increased, but by twice as much. As the market has decreased by 1 unit, in my example, the Apple stock has also decreased, but twice as much. So that means this specific stock is moving in the same direction as the market, but more extreme. That makes it more risky. So, what would the beta of this stock be? CAPM Beta measures the risk of a specific stock relative to the risk of something else. It's a relative metric. So, beta tells me what the stock is doing in relation to the market portfolio, the green line, the NASDAQ. So in my example here, the beta of Apple would be probably something like 2.0. As the market goes up by 1, what kind of movement does my individual stock do? It goes up by beta, it goes up by 2. As the market portfolio goes down by 1, what is my specific stock, Apple in my example, doing? It goes down by beta, it goes down by 2. So beta is not an absolute risk metric, it is a relative risk metric. Okay? You could ask me, hey Flo, how heavy are you? I could give you an absolute answer. I could say 90 kilos. I could also give a relative answer. I could say, I think I'm heavier than you. I think I'm lighter than you. So this here is more like my second example. I'm not saying the stock is very risky or not risky. That's not a statement I make. That's not a statement that beta allows you to make. Beta allows you to make statements along the lines of, this stock is more risky than the market. But we are not making statements about the absolute level of risk. Let me plot a different example. Let me plot in red now. As the market goes up, my stock also goes up. Have a look at this. It's still Apple. As the market goes up by 1, the green line, that's completely unchanged. Our specific stock, Apple in my example, also has increased, but only by half of it. As the market goes down by 1, again the green line, our stock also has gone down, but only by half of it. So the red line representing Apple now in my new example, is it more risky than the market, as risky as, or less risky than the market? Unmute yourself, shout.
Less.
Yes.
Very nice. Absolutely correct. Excellent, guys. So I would say in my example, we are looking at a beta of roughly 0.5. What does it mean? As the market, the green line, the index, the basket, the NASDAQ in my example, goes up by 1 unit, what's my stock doing? It makes a movement of beta. So as the market goes up by 1, the specific stock Apple goes up by only 0.5. But you see it moves in the same direction still. As the market goes down, the green line, by 1 unit, our stock also goes down. It moves in the same direction, but less so. It only goes down by 0.5, making it less risky. It makes the same movements as the market, but less extreme. And last but not least, maybe just to do some weird stuff, have a look at this. Third example, beta Apple, that's blue now. I don't know if you can see it well. The market goes up by 1. Look at this. Ooh. I'm not going to ask you now, is this now more risky than the market or not? Because clearly we have left sanity behind us. I only want to talk to you about what we are observing here. This is now really weird because as the market goes up, the green line still, the NASDAQ in my example, goes up by 1. What's our specific stock doing? It goes down by exactly the same amount. So it moves against the market completely. So it's almost like negatively correlated. So in my example here, the beta would be -1 now. My example is not very good because Apple would not behave like this. So I'm deleting this because it makes me a bit uncomfortable. Mathematically, a negative beta is possible, but I have a question for you. Is there any asset in the real world, not only stocks, but just think about it, is there any asset, any investment you can think of that would move against the market, that is doing very, very poorly when the stock market is doing well, and the same asset is doing really well when the stock market is suffering? Is this a theory? Huh?
Inferior goods, maybe? Bonds.
Bonds?
Gold.
To some extent.
Who said gold?
I did.
Yes, very nice. Gold moves like this. Why? The reason for that is not a mathematic property, it's a psychological property. What happens? I want to draw your attention to a specific part of my diagram here, where the market moves down. This here, okay? Let's only look at this part. What happens when a whole market, in my example the NASDAQ, the whole technology index decreases? Maybe even decreases very quickly and a lot. What do investors think? Feel free to have a different opinion. I'm rather cynical. I think investors only know 2 emotions, greed and fear. So in this phase, investors are typically greedy and think, yeah, well, I'm riding now the profits to the sky. The moment this happens, investors panic and freak out and get scared. And what they want is they want to exit their investment. They want to dump their stocks. So as the market turns down, a lot of investors will go through the same emotions. Oh crap, I should sell my stocks. And they all dump their stocks on the market at the same time, basically wrecking the stock price even more. So meaning the stock price goes down even more. But they are investors. They need to put their money somewhere. So then investors flee, escape into something they perceive as more stable. So they buy gold then. So as they are selling their stocks, at the same time they start buying gold because they perceive it to be more safe or less risky. And because all of them or a lot of them at the same time buy gold, they drive up the gold price. So as the stock market goes down, at the same time the gold price will increase simply because of supply and demand. So absolutely correct, gold typically has a negative beta. Yes, very nice. So is the beta concept clear? It measures firm-specific risk of a specific firm, Apple in my example, really of one specific equity instrument of the share of one firm. A high beta indicates a stock is more risky than the market. A beta of exactly 1, that's the one case we have not looked at, which is relevant though. I'm running out of, no, I need a cool color. Oof, pink, nice. It's also possible to look at this here. It's difficult for me to draw. A stock that moves like this, I don't know if you can see it, I've tried to draw a pink line exactly overlaying the green line, the market portfolio. That would be a beta of exactly +1. That means a stock is exactly as risky as the market. It makes exactly the market movements. So that is what beta is. And I want to go back to the CAPM and wrap this up now in a neat way. So have a look here. CAPM. This is the CAPM. Reminding you, we are calculating the return that you as an investor think you require for you to be willing to invest in my firm. My firm here is Apple. You want to be compensated for your time and the risk, not just any abstract risk, the specific risk of my firm, Apple in my example. So this whole term here tells us the risk compensation. Let me walk you through this now. I will zoom in on one specific term, the bracketed term only, RM minus RF. So first of all, the bracketed term, I already saw it in the YouTube chat pop up briefly. The whole term here is called risk premium. Risk premium. I know I have dropped a lot of complicated concepts today. I need you to focus now for maybe 2 minutes more, but it's really crucial. Have a look at this. Why is this called risk premium? What happens in the bracketed term conceptually? RM is the return of the market portfolio. In my example, it was the index, the basket of stocks, to which this one stock we are analyzing belongs. So in my example here now, it's the NASDAQ. It's the average return that all the stocks, the technology stocks in this basket earn, an average return. RF is of course the risk-free rate, the risk-free interest rate. So what? We zoom now in only the return on the market. It's also a return metric, and you know return consists always of 2 components, compensation for time, compensation for risk. So what does RM compensate you for? If had you invested in the whole market portfolio, so in the whole index, this is the return that you would earn, compensating you for the time and for the risk of having invested in this whole basket. So if this metric, the return, includes compensation for time and risk, and I deduct RF, which itself is the compensation only for time, the bracketed term gives us a percentage how much the whole market portfolio compensates investors only for the risk of having invested in the whole index, not time anymore, because I have deducted RF, which is the compensation of time. So the bracketed term, the risk premium, what it actually compensates you for is compensation, this is really important, compensation only for risk of whole market. Not time, okay? Not the time. So that's the bracketed term. That's the compensation for the risk of the whole index. but I need to get the the firm-specific risk compensation. So how can I get from the risk compensation for the whole market to the risk compensation of one specific stock? Simple, by multiplying with the firm-specific risk metric beta. Boom. So this whole term here gives us the risk compensation calculated as what is the compensation for the whole risk of the whole market, not the time, only risk, multiplied then with the risk of the specific stock. Does this check out, guys? Does it make sense?
Yes, but I have a question about the beta.
Yeah?
Well, it's company dependent, right? But is it always the same? Because correlations can change, right?
Yeah, absolutely. Give me a second, okay? I love your question. I'm just not quite there yet. I want to make sure that... Super. I want to make sure that everyone understands the logic here. So tying this together, we are saying you're an investor, you're considering investing in my firm Apple, and you know, if you were to invest, you want to be compensated for two things, time and risk. The compensation for time is simple, it's simply the risk-free interest rate. But the compensation for risk is a little bit of a taller order. Because we need to first figure out what's the compensation for the whole sort of risk of the whole market, and then modify it by the firm-specific risk. And that is what is happening here. Is really everybody on board? Wait, I need to open the Zoom chat, not that I'm overlooking something.
I have a question about the terminology.
Bring it.
So, when you say risk premium, do you refer to the market risk premium or the firm-specific risk premium? So in the brackets, that would be the market risk premium, right?
That's correct.
Okay.
Yeah.
Thank you.
Yeah, sure thing. Okay. Coming back to the question, that was an excellent question. Huh? Is beta, if beta is a bit like a correlation, we know correlations are not stable. So what about beta? That's a very, very cool question. It's very advanced, but I want to address it because it is super relevant. So
Can I add to it? Because you want the expected return, or you want to know that, but it's on a certain time. You want to know it on a specific time.
At a specific point in time, yeah?
Years, right? So which beta should you use?
Yeah. Okay, you have a very specific question, that's great, but I need to put your question into context for everybody. So the problem is, beta is not a stable metric. Look at my diagram. Where is it? Look at my stock chart here. It depends, of course. No, let me make a new one. Let me make a new one to answer this in a neat way. Have a look at this stock chart. This is of course my timeline, T+, and here I plot returns. Nothing new. And I plot now the movement of the market. So let's say the market moves like this. This is RM. And then I plot now the movement of a specific stock in red. Let's say it moves something like this. It's theoretically, of course, possible. If you then calculate beta over this period of time only, from here to here, you would get a beta of something like maybe 2.0. If you were to calculate beta only for this period, you would get a beta of roughly -1. And if you calculate a beta over 2 periods, beta simply measures the strength of the relationship, you would get something in between, I don't know, that's really, I have to guess now, I don't know, maybe 1.3 or something like this. So the question is super relevant. What is the correct way to calculate beta? It's certainly not part of my official agenda today. I want that you understand the CAPM, but there is no correct answer what the correct way of calculating beta is. It depends what you want beta to include. I give you an example. So let's say I were to be, we are interested in investing in Netflix. let's say, but we are very risk sensitive, so we look at, well, what's the beta of Netflix? If we look at the last 2 years, pandemic time, Netflix has profited immensely from the lockdowns, because what else can you do than just watch Netflix all day? So Netflix stocks have performed really well over the pandemic period. If we calculated now beta of Netflix over the last 2 years, the result would be a very low beta, indicating that Netflix is a lot less risky than the market. If you were to calculate the beta of Netflix since the company started existing, the beta would probably be quite a lot higher. Which one is more correct? Cannot really say it. As an investor, I would care more about more recent developments. I don't really care how risky Netflix was 10 years ago. So I would try to pick a beta that captures economic reality most accurately. So I would probably, in the case of Netflix, I would probably calculate Netflix beta over not just 2 years, but maybe over the last 4 years. A little bit before the pandemic and during the pandemic, to get a little bit of a fair or sort of honest representation. Okay, so there is unfortunately, no way how I can answer the question very accurately. You need to consider the context in which a firm is operating. Or another example, imagine, this is really a completely invented thought experiment to drive home my point. Imagine a new law were to be passed in the Netherlands that said, all those violent shows like Squid Game and so on, this is just not okay. It just messes people up in their head when they watch it. So from now on in the Netherlands, the use of Netflix is forbidden. It's legally not allowed anymore. And this law will be passed tomorrow. Yeah, if I calculate then the beta of Netflix, including all the data up until today, it looks like everything is A-okay. But if I already know that tomorrow the use of this will be illegal, it's of course a completely meaningless metric. Okay, so for beta, you need to really consider the ramifications and the context. And last but not least, for all publicly listed firms, you can look up beta online like this. And it says then beta equals 1.3. In the context of this question now, I want to stress how important it is to not simply look up a firm's beta and then just run with it, figure out which period is covered. You always can look this up. Is this a 1-year beta, a 5-year beta? That matters for the interpretation, okay? Okay, I just want to go back and put everything together in 2 minutes. This year. What is going on? We are a company and we are on the left side. I told you, in corporate finance, we concern ourselves with 2 questions. In which assets should I invest? How should I finance them? How we should finance them, this is content that we will address in this course, starting with our next lecture, to be determined. This here is something we know now. We would answer the question, should we invest in a project, yes or no, by doing a net present value calculation. We forecast the cash flows as best as we can, and we discount them all back to T0, and the logic is, if the net present value is positive, it means yes, we should do the project because it will add value to our firm. If the net present value is negative, we will reject the project. But immediately we have to acknowledge that we cannot calculate the net present value because we don't know the risk appropriate interest rate for our specific firm. So that brings us then to the WACC. In order to be able to calculate a net present value, we first need the WACC, which is gonna be our discount rate. So the WACC is simply calculated as the weight of equity, how much equity do we have, multiplied with the cost of equity, plus the weight of debt, so how much debt do we have in our capital structure, multiplied with the cost of debt, multiplied with 1 minus the corporate tax rate. And the point of this term is simply to incorporate the fact that interest expenses are tax deductible. It helps us save taxes. That is what this term achieves. But we cannot do this because then we have to acknowledge that in order to calculate a WACC, we need the cost of equity, which we don't know, the cost of our own equity. And in order to answer that, we decide then to apply the CAPM, the cost of equity from my perspective as the firm. If you as investors apply the CAPM, you will say you are not calculating a cost of equity, but a required return. Again, think of this strange relationship, interest expenses, interest income. It's the same kind of cash flow. Depending on who looks at it, it will have different terms. So the CAPM says the required return from your perspective. For the sake of my example, I'm calculating a cost of equity, consists of two different components. RF, that's the compensation for time, plus a whole bunch of other stuff, that's the compensation for risk. So compensation of time plus the bracketed term, as we've discussed, is the risk premium or market risk premium. It's the return of the whole market portfolio. So the basket that contains similar stocks as the stock I'm analyzing, Apple, whatever. In my example, it was NASDAQ. Minus RF, which is the compensation for time. So RM in itself compensates you for the time and it compensates you for the risk of the whole market. So if I deduct the compensation for time, the bracketed term is then the compensation only for risk, for the whole risk of the whole market. And if I then multiply it with the firm-specific beta, I end up, that's the second part of the compensation here, with the compensation of firm-specific risk. And when I add then RF, so the compensation for time, plus the compensation for firm-specific risk, I get what you as investors refer to as required return, and what I as the firm will refer to as my cost of equity. And that is it. Logically, these are the steps. You would walk through the steps logically like this. Mathematically, obviously, you cannot do this because there's always an ingredient missing. So in the real life, you mathematically would approach it like this. You first need to calculate the cost of equity. Once you have the cost of equity, you can then calculate the WACC. Once you have the WACC, then in the last step, you can do the net present value calculation. So that would be the mathematical sequence of events. All right? Woo! So guys, sorry, I know there was a lot and a lot of mathematic stuff, but this is really relevant, and it's also relevant that you understand it. Not just the math and fill in the numbers and hope for the best, but there is a logic to it. Guys, did everything what I said make sense? Are there any questions? Anything I can explain? I need to clarify anything that goes beyond this. All clear?
Do you have a question that goes beyond this, if there are no specific questions for the material?
Bring it, Dylan. What's your question?
So, right now, how do you look at the changes that are happening right now in finance? So, for example, we have a really low interest rate. How do you look at that with what ramifications does it have for the finance methods we use currently? With, for example, with exercise, we usually get like 4%, 3%, like last year. How would you say that changes perhaps in the coming years, or how would you say that we need to take that into account when doing these exercises?
Well, for exercises, it has no implication because an exercise from a textbook is, of course, artificial, right? I mean, I see no connection there. But your question is very relevant. Let me show you why. We used here a net present value calculation to determine should we do a project or not. But you can actually use net present value calculations to do something that is called fundamental stock analysis. A couple of you asked me in private chats if I would advise you to engage in technical analysis, technical chart analysis, stuff like this. And my advice is, no, because it's pseudoscience. The way to determine if you should buy a stock or not is technical analysis. And how that works is like this. It is also a net present value calculation, so it fits our topic. Let's say I want to figure out if I should invest in Apple or not. I would then look at next year, T1, T2, T3, and so on, infinite. And I would, for every year, I would try to forecast the net income that Apple, in my view, will earn next year. 100, I don't know, 150, 130, I don't know, irrelevant. But it doesn't tell me if I should buy the stock or not. So what I would do then is I calculate the present value of the net income of Apple for the future. So I would say present value of net income Apple equals, in my example, there's now no initial cash outlay. I'm just calculating the net present value. 100 divided by 1 plus discount rate to the power of 1 plus 150 divided by 1 plus discount rate to the power of 2 plus 130 divided by 1 plus discount rate to the power of 3 and so on. And I will end up with a present value of the net income of Apple. It will be some sort of number, whatever. I call it now X, doesn't matter. So this is then the present value of all the future net incomes that Apple will earn. So that's basically the money that's available for all the shareholders. But I am not all the shareholders, or I will not be all shareholders. I'm just one shareholder. So how can you translate this into a stock price? You would look up then how many shares of Apple are traded, are in circulation right now. So let me replace this maybe with a concrete number, just something I invent, of course. Let's say the present value of the future net income of Apple is 1,000 euro. And then I look up number of shares outstanding. It's really, of course, completely invented. Let's say Apple has only 10 shares in circulation. Only 10. What should be then the fair stock price, the fundamental stock price? Well, if this is the present value of all the future net incomes, and that belongs to the shareholders, that's divided over 10 shares, what should be the share price? 1,000 euro divided by the number of shares, so divided by 10. So that would give me 100 euro. So in my wording, I would then say the fundamental stock price of Apple should be 100 euro based on my calculation. And then I look, what is the actual stock price of Apple right now? Let's say the actual stock price, I look it up, and let's say currently one stock is traded for 90 euro. Should I buy it or should I sell it? Well, obviously it would be undervalued. The future earnings situation indicates that it's actually more valuable. So if it were only traded right now for 90, I would go ahead and buy it. If currently it were traded for 110, I would in my wording say this stock is overvalued, so it's only a matter of time until the market realizes this, sells Apple stocks because they're overvalued, and the stock price will drop to 100 euro. So that is the mechanic. And to come back now to Dylan's question, how do interest rates influence finance right now? There's one problem that we're encountering and nobody really knows how to deal with it. And that's, I don't know, Dylan, if that's what you were interested in, but that's what I'm willing to say about it. Dylan said, well, the interest rates are now really, really low, and the textbook sometimes says, well, discount rate is 4%. A low interest rate is not a problem for discounting. So I don't care if I discount here with 4% or 3 or 0.5. It's much worse than what Dylan has hinted at. What do we do with our beautiful valuation model when interest rates are negative? What? I mean, and that's not science fiction or fantasy or anything, that's real life. I mean, interest rates have historically every now and then been negative, and we're experiencing this now every now and then. So it has become kind of normal that interest rates drop below zero, and that is something that nobody can really tell you what happens or what's the meaning of a result that you have obtained by discounting with a negative interest rate. So what I'm willing to say in a brief refresher session about the impact of interest rates on finance right now, what is a huge problem in finance and in corporate finance is the impact of negative discount rates or negative interest rates on any valuation model. The moment you have to do compounding or discounting in whatever context for stock prices, for investment decisions, it really, I don't even want to say it gets messy, it's just not clear to us what that means, what we are supposed to do then, because discounting with a negative interest rate gives no meaningful results. So we just don't know. There is research on that. Scientists disagree. As far as I can tell, it is not clear. Sadly. Does it make sense, Dylan, what I'm saying?
Yeah, thanks. I was indeed referring to more negative rates, so this
Yeah.
makes sense.
Yeah. It's really a problem. If you're interested in these things, Dylan, or other students that think about this, I mean, I don't want to do advertisement for RSM. I mean, stuff like this is, if that's interesting to you in the second year bachelor, I mean, look into the finance, in the Master of Finance and Investment, maybe. That could be for you then. Guys, is there anything I can do for you to make you a bit more comfortable with this content? Is it clear? Everything understood? Let me see here in the chat. I see in the YouTube chat, drop Tesla, guys. Haha. I'm not gonna comment on this. Guys, I know this was a lot today. I really appreciate that you can do this kind of stuff with me at 9 in the morning. I mean, that's really impressive. I have uploaded slides. As I've said, I'm not really using every single slide, but everything we have discussed here is in a beautiful, neat way also on the slides, right? So that's really something you can read up on. If there are no further questions, I wish you a nice day. Thanks for joining me. Have a good day.
Can I ask one more?
Yes, sure.
Yeah, okay, because this is something that never became clear to me last year.
Bring it.
It's about having an NPV with like more than one project, and then like comparing the net present value.
Sure.
So last year we learned that you conduct a project when it's a positive NPV, and when you compare projects, you choose the highest one.
Yes.
But
if they are mutually exclusive, normally you can also, yeah. Mm-hmm.
Yes, what I learned in the past is that sometimes you have different investment amounts. So for example, you have a project which the initial investment is more than the other one. And what I learned then in high school is that you cannot directly compare them because you have different initial investments. So the final NPV is not resembling the same type of present value. So what I learned was then to calculate the net present value per invested euro. So like to divide the net present value by the investment amount. But the teacher last year said that that was not relevant. But I was specifically taught to do that, and I'm not sure what the right way is. To only look at the final value or to divide it by the investment amount.
I know exactly what you mean. I think I'm not really willing to say that's right or wrong. The correct way to deal with this is to include in your net present value everything that matters. So the only reason why sort of analyzing an investment on a per euro basis would be that your net present value setup was so sloppy that you did not include here costs of financing and stuff like this. So if you set up your net present value calculation, so all your input parameters in an accurate way, all those financing costs, those side effects, they should all be part of the cash flows here, and then you don't need to consider the investment, the project on a per euro basis. But it's a matter of how accurate you have set up your net present value calculation to begin with.
Okay, so it's a matter of setting up the right parameters.
Absolutely.
And then,
absolutely.
Yeah.
A net present value calculation is only as good as the input that you put in. I said, for example, this is a great example here. I said, let's just calculate the present value of all the future net incomes of Apple. You cannot forecast net income directly. Net income, strictly speaking, is of course the difference between revenue and all your expenses. So in order to forecast net income, you would have to forecast revenue alone, and you would have to forecast every single expense, and interest expenses would be part of all the other expenses. And just for revenue, in the context of Apple, how easy or not easy that is to forecast, you would have to forecast the revenue that Apple will make with their phones, with their iPads, with all their different products basically. So you would do this really in a very fine-grained way. I have pretended here that I can forecast a grand total, which is completely impossible. So, and again, I have to stress again, this is an estimation. This is not going to yield a very accurate result to begin with. But the accuracy of the present value or net present value calculations can be influenced in a positive way by being as accurate in your forecasting as you can, forecasting of your cash flows, and financing side effects, that's definitely something that should be there, no question about it. We have also one lecture, that's something I did not mention on Monday. We have a lecture on valuation, that's part of our curriculum, where we will look into this, Dylan. So the different kinds of cash flows that you can use for valuing a firm, and then we will elaborate a little bit more how these side effects can be considered. All right?
Okay, great. Thank you.
Super, guys. Have a great day. Don't forget, on Fridays, Celine has prepared really cool workshops. I think it starts at 12. The BA workshop will be taught in Dutch. The IBA workshop will be taught in English. Celine and me communicate very closely, so if there are any trouble, when she realizes you're struggling with, she will basically tell me so that we can address it in class again. I would strongly advise you to go. Okay? Guys, have a great day, and I see you at the latest next week. All right?
All right. Thank you so much.
See you guys. Doei.